There's more fake data. I'm your host, Steve Van Metre, and thanks for joining me today. You may remember earlier this month, we broke a story about how the payroll data was likely faked as it didn't match any other data series or any other expert's opinion. Well, now we've got more news as the Bureau of Labor Statistics is back again, now with the CPI report. But something you don't know that actually happened is following that video on the payroll report, an agency inside the White House reached out to me. Now, you may be wondering who they were. Well, it was these folks here at the Information and Regulatory Affairs. The Office of Information and Regulatory Affairs is a statutory part of the Office of Management and Budget within the Executive Office of the President. And that's right, they reached out to me to let me know that the data wasn't faked at all. In fact, that they believe it was done to the highest level of integrity that the government can do. But that didn't stop them from also saying they're going to look into why the data series was so far off, but they still maintained that it was highly accurate. So now that you know they are watching this show, I want you to know that if you have an opinion about what's going on with the data, well, the comment section is yours, and you can better believe that they're going to be reading it because they are now taking an interest in what we're talking about. Because as we move forward to the payroll report, which is due out Wednesday, we note that the Bureau of Labor Statistics is making some changes. Now, I'm going to give you both sides of the story. I'm going to give you the official view, and I'm going to give you the unofficial view of why the timing of this change is not actually good, and it will have major implications on monetary policy. Plus, we've got a surprise twist at the end that has to do with none other than the White House. Let's over to Zero Hedge, where we picked today's story up with the headline, here's what today's adjustments to the CPI seasonals and weights mean for Tuesdays. That's right, Valentines Day CPI print. And you can better believe that this is going to be one of the most watched CPI prints that you've seen. Now, of course, we note that all the Federal Open Market Committee press conferences are hotly watched, but you can know that any CPI report in the months to come is going to matter in a big way, because this is what we know that monetary policy is being based on. So if it goes higher, then you can expect more rate hikes. If it goes lower, then the Fed pause comes into play. And if it goes sharply lower in the months to come, the odds of a rate cut then start to come into play. This has major implications for the stock market, the bond market, and monetary policy. And that's why this is such a big deal. While every trader and analyst is laser focused on the Valentines Day Massacre, when a closely watched CPI print will mean lots of market pain, or maybe not, few are paying attention to a new development today that when the Bureau of Labor Statistics released its annual seasonal adjustment factor recalculation, which at a time, and this is a point we want to make in today's show, when the smallest move in the CPI is closely scrutinized, not only revises up to 5 years of data, but which could have profound impact on Fed policy and thus asset prices. So this is a big deal. But now I want you to be aware, this is the official view. Is this seasonal adjustment, this change? Well, it's actually scheduled and happens every year. Here we go to the Bureau of Labor Statistics. Each year with the release of the January CPI, seasonal adjustment factors are recalculated to reflect price movements from the just completed calendar year. This routine annual recalculation may result in revisions to seasonally adjusted indices for the previous 5 years. So there you have it. That is the official word. Now keep in mind, again, this happens every January, but right now this is a very critical time as we all look towards where monetary policy is going, where the stock market's going, where the bond market's going. You can tell the BLS here can have a major impact on Tuesday and how the markets are likely to react and what the Fed is likely to do. Let's dig a little deeper. While not extreme, Zero Hedge notes the adjustments did have an impact on the underlying data, and nowhere more so than the latest December report, where instead of falling, so here we go, key part falling as previously estimated, consumer prices actually rose. So you can kind of already get this picture that what if the CPI was rising ahead of the recent FOMC meeting? Would Fed Chair Powell and the board have changed their opinion on this? We don't know, but you can see just how big of a factor the BLS plays here. Specifically, December headline CPI rose 0.1% month over month instead of dipping 0.1% as originally reported last month. The Labor Department's annual revisions of CPI data showed on Friday. Data for November was also revised higher to show the CPI increasing 0.2% instead of 0.1% as previously estimated. In October, the CPI rose 0.5%, revised up from a previously reported 0.4% increase. So here you see the 3 big months, all the CPI went up, and you start to ask the question of how would this have changed monetary policy? How would the markets have reacted potentially differently to this data? Now let's head over to the Wall Street Journal where we've got Nick Timros. Of course, we know he's got the ear of the Fed. Let's see what he has to say. New CPI weights changed the inflation picture slightly. There we go. At the end of last year, showing somewhat less deceleration than before. Core CPI rose at a 3 and 6 month annualized rate of 4.3 and 5.1% in December, respectively, up from 3.1% and 4.6% under the previous price profile. We do want to note, because we don't want to throw Nick under the bus, that he did add the BLS published new weights and new seasonal adjustment factors, which changed the profile. So we want to make sure that he's accurate here in his reporting. So what he's saying is it changed the deceleration. That could have changed the whole scope of how the Fed reacted. So now we're going to look a little bit forward and see what do these changes mean. But one thing that should matter here, I think there's 10 coupons left for CTA Timer Pro. If you're long the market right now and you're following the machines, this report will let you know when you need to scale back. Look at what it's already telling you on the bond market for our subscribers on Friday. It caught that move to the downside and already let you know. But now let's head over to JP Morgan, who says a quick reaction to the updated CPI seasonals now. And again, for the CTA Timer Pro, $10 off coupon. I think, again, 10 left. Link in the description below. Let's take a look at what JP Morgan has to say. Said another way, if your expectations for prices before seasonal adjustment did not change as a result of the updated seasonal factors, the change in the seasonal factors likely would now lead you to expect weaker seasonally adjusted inflation in the early months of 2023. So as they look backwards now, they're saying we think this actually could lead to weaker CPI now. So that actually goes against what the Fed Chair Powell recently said, not only the press conference, but at the Economic Club in New York when he spoke there and said that we expect to continue to raise rates. But now all of a sudden the seasonal adjustments, at least according to JP Morgan, let's look here. Historically, they say this tends to undershoot. You're noting before the revision in orange, after the revision in blue, that sometimes it revises lower. And they say in the beginning of the year, it tends to revise down. It's going to have a major impact on what the Fed says. And it also impacts the core CPI, not as much, but a little bit as well here. So we get the distinct impression of what's going on is the Bureau of Labor Statistics, while we can maybe say the data isn't faked, the timing of this report change maybe should be put on hold. But I want to know what you think, because now you know that the White House is watching and listening and responding. Here's your chance. Let them know what you really think of that payroll report and of this upcoming Bureau of Labor Statistics change in the CPI report, because it has major implications. Now, for the twist, the White House, well, they had something to say too, and let's check it out. New White House wage data shows slowing pressure on super core inflation. Question is, what is this super core inflation? And now all of a sudden you see this weird thing, right? The Fed is saying hike, hike, hike. We got to hike more. The market's saying we don't believe you. The BLS is saying, hey, we're going to revise this. And well, JP Morgan's saying historically revisions lead to lower inflation. And now the White House is saying, wait a minute, maybe all the wage data is wrong too. Some economists have dubbed this narrower measure supercore to distinguish it from core inflation, which excludes just food and energy. In December, annual supercore inflation was running about 4% below overall inflation of 5%, but still double the Fed's 2% target. So get that. Let me say this again. Annual supercore was running 4% below the overall inflation. So that's telling us that if the supercore leads the core, which leads the inflation, actual headline, then that tells us that inflation is indeed slowing. But of course, we already know that is coming. That is according to the price index of personal consumption expenditures, the inflation gauge that the Fed prefers to the better known consumer price index. So again, saying inflation is slowing down. Some surmise that the tight labor market may be playing a meaningful role in this part of inflation, according to the White House Council of Economic Advisors. So here, now we're getting into the fact that they're saying the labor market is tight. We know the Fed has made that claim, but what is this issue with wages, you're asking? Well, let's dig into that too. To remedy that gap, CEA economists constructed a wage theory tracking only wages that go into supercore prices. By this measure, supercore wage growth for non-management workers. So this is rank and file. These are the people that matter, the ones that are out doing the work, has ebbed significantly in the past year from 8% on a 12-month basis to 5.2% in January, the CE calculates. So here you go, right out of the White House's own people. They're saying, look, wages are falling at a faster rate than inflation. Now you start to get to the bigger picture of why the economy is slowing down, and yet the Fed still thinks they need to hike rates. Do you see what's going on here? None of this makes any sense. That is much steeper than the drop in wage growth for all private sector workers from 5.9 to 4.4 in the same period, and for non-management workers from 7 to 5.1. The drop is even sharper looking at shorter periods, according to the CA's measure, such as wages were growing at 9.7% annualized in the 3 months ended October 2021. By January, growth had slowed to 4%. Below that for all private sector workers at 4.6% and private production workers at 4.4% in the same period. So now it makes sense. Why are people using their credit cards? Why are they now running down their savings? They're out of money. And the government data is so lagged and so far behind that it doesn't actually catch this. But what you see is the Fed makes policy decisions on this all the time. And in keeping with White House policy, the CA didn't comment, why would they, on the implications of its work for Fed policy. Nonetheless, the deceleration it identifies could be significant for the path in interest rates. Again, here you go, full story. Now you see all the dots connected. You have this payroll report, which didn't make any sense, was double what estimates were. Now the BLS is coming out with the CPI revisions, which maybe logically it should say, you know what, we need to maybe put this on hold because we will have a significant impact in monetary policy. And now you have the White House saying, hey, wages are crashing a lot faster than we thought, and maybe this will actually have an impact on monetary policy, but we don't actually have anything to do with that. And so you start to see none of this makes any sense, but what it does tell us, the government knows a lot more than it's telling us. You've got the opportunity to tell them what you think in the comments. And with that, I'm Steve Van Metre. Thanks for watching, and as always, thanks for being fans. Bye now.